What's up, Money Minds, and welcome back to Market Briefs Video Edition. Today is November 8th, and here's some business and financial news you can finally use. Drivers around the country are finally getting their tips back. Around 140,000 Amazon drivers whose tips were allegedly withheld for multiple years are finally getting reimbursed with a check from the FTC, or the Federal Trade Commission. The FTC is sending out over 139,000 checks, which is just over 1,600 payments. The payments equate to around $60 million that Amazon allegedly withheld from its drivers from 2016 all the way through 2019. Next up in our financial tip of the day, here is one of the best ways to ask your boss for a raise. There are a lot of different ways to ask your boss for a raise, but whatever you do, do not just run into your boss's office and scream, "Hey, I want a raise." There are a lot easier and way more efficient ways to ask your boss for a raise. And before you do anything, you really need to nail down your reasons for why you want a raise in the first place, or why you think you deserve one. If you're still struggling with this, our team put together an article on the 5 best tips that you can use to get a raise from your boss. So if you want to read that article over on theminoritymindset.com, I will leave a link to it in the description below. Next up in our market preview, stocks ended a bit higher to end last week due to the positive October jobs report. Hiring for the month saw many sectors gaining very sharply, which is a super positive sign for the economy, which is currently struggling with supply chain issues and a labor shortage. We've got more details on both of those issues later on in this video newsletter. Coming up this week, we have earnings from Disney, PayPal, Oracle, and Tencent. Next up in our first main story of the day, let's talk all about jobs and how things improved for the month of October. But before we get into all of that, my name is Nate from Minority Mindset News, and if you like this video, make sure to smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world. We can keep making videos just like this one. Last Friday, the full October jobs report was released. Drumroll please! Non-farm payrolls increased by around 531,000 for the month of October, which actually beat estimates that were only around 450,000. And unemployment fell to a new pandemic low of around 4.6%. In addition, wages are up around 4.9% when compared to the same time last year. Similar to the private payroll report, the leisure and hospitality industries led the job creation field. Manufacturing and business services were not that far behind though. And the supply chain got a much needed help. Transportation and warehousing, which again is a huge part of our supply chain, added around 54,000 workers last month. And as you can probably imagine, the markets took this news very well, as most markets ended in the green for the week. But despite all of this positivity, economists are wondering if this worker shortage has changed for good. Compared to pre-pandemic levels, businesses are struggling to attract and keep new workers. The number of people actually looking for jobs in October remained flat, and the turnover rate across America is still abnormally high. Next up, we have our market mover section, and let's focus on who trended up last Friday. Airbnb rose by around 12.98% after it reported better than expected earnings for the third quarter. Canada Goose flew sky high by around 19.37% after it reported great results for the third quarter as well. Live Nation gained around 15% after the event promoter saw increased demand for concerts, events, and live shows. In addition, Expedia also jumped by 15% and joined the ranks as another reopening stock. Travel demand is increasing across the world, which is why Expedia had around $3.53 per share last quarter, which actually beats the $1.65 that Wall Street was expecting. And finally, Uber was up by around 4.3%, beating expectations, mostly due to its food delivery business. That's it for our main stories of the day today, so let's take a quick break to talk about today's sponsor, M1 Finance. Here's the thing. Most brokerages will charge you more every single time you invest more. Here's the other thing. M1 Finance is not like most brokerages. In fact, they let you invest passively without paying a single penny in commission. And when you invest with M1 Finance, it is as easy as, number one, just pick your pie. That will show M1 Finance exactly how you want your money to be invested. Number two, set up automatic deposits. This will ensure that a certain amount of your paycheck goes towards your investments every single month. And number three, just sit back and let the market do its thing without worrying about commissions. What's even better is that opening an account with M1 Finance is completely free. So if you want to learn more and start investing with M1 Finance, I'll leave a link in the description below on exactly how you can find them. Big shout out to M1 Finance for sponsoring this video. And now, back to the news. Next up, it looks like it was way more pain than gains for Peloton after they reported an abysmal earnings report for last quarter. Peloton dropped as much as 36% on Friday after it slashed its annual sales forecast by as much as $1 billion. The fitness company blamed the lack of consumer demand as the main reason for its forecast slash. The pandemic sparked a new love for treadmills and stationary bikes, and Peloton really benefited from that. Peloton saw a massive increase in 2020, which coincided with the stay-at-home orders. But it looks like that is officially starting to fade. On the flip side though, Planet Fitness hit an all-time high last week. The brick and mortar gym also announced that its memberships are back to pre-pandemic levels. In the meantime though, Peloton said that it is making improvements to its materials so that way in the future, it can start lowering its prices. Next up in our mind blown section, if you could go back in time, is there anything that you'd want to do differently? Maybe you could go back and right some wrongs. You could even relive some experiences, or you could put a few bucks into Tesla stock. Tesla stock is up by over 50% since the beginning of October, and it has a new market cap of around $1.2 trillion. But if we're talking time travel here, how much money would investors have if they got on that bandwagon just a little bit sooner? Back in November of 2020, Tesla shares were trading at around $400 per share. Investing $1,000 during that time would now give you a 194% return, or around $2,924. If you go even further back though, in November of 2016, Tesla shares were only around $38. A $1,000 investment back then would now give you a 3,025% return, or $31,286. That's a big jump. To compare, the S&P 500 has only grown by around 142% during the same time. If we go even further back to 2011, Tesla shares were trading at around $5.74. A $1,000 investment back then would now have grown by over 20,000%, and you now have over $204,000. And to compare, the S&P 500 has only grown by around 357%. Next up in our mind break section, interest in going to a four-year college or university has sank to a new all-time low. More high school grads than ever before are looking for other opportunities due to universities skyrocketing tuition costs. A recent study showed that only 48% of high school students are interested in attending a four-year school. This is a massive decrease considering the same study was done about a year and a half ago and 71% of students were interested in a four-year college back then. While most admitted in the survey that they felt some pressure to go to schools from their parents and teachers, the fear of crippling student loan debt has pushed them to stay far away from enrolling in college. Tuition and room and board for an in-state public college grew to around $27,300 this year on average. This coincided with undergraduate enrollment dropping by around 3.2%. Compared to 2020, enrollment has dropped by around 6%. That's the largest decrease we've seen in around 5 decades. And lastly today, we have our Money Mind section. We pull comments directly from you all on our YouTube, Instagram, and TikTok accounts. Today's comment is from Malcolm B on our YouTube channel, and the comment reads, "He got right into the numbers in less than a minute. I love it. Not wasting any time giving us that information." Thank you so much for that comment, Malcolm. And if you want to see where this comment came from and the numbers that he's talking about, I'll leave a link in the description below to a YouTube video that Jaspreet just made on the current and possibly future housing situation. So if you want to watch that video, check out the link in the description below. We are going to wrap it up right there for today's Market Briefs newsletter. But if you like this video, make sure to hit that subscribe button below. Keep hustling, Money Minds, and I'll see you all in the next one.